Taxes and investment properties. Hi, I'm Amol Heda with Keller Williams Bay Estates and author of Thriving Through Ownership. It's tax time, folks, and I'm talking to those people who own one or more investment properties. You know the routine. Most people buy their first home, don't sell it, just rent it out, and once they rent it out, they move into their upgrade and make that their primary, and this is their investment property. Or there are those that keep collecting investment properties as a part of increasing their real estate portfolio, and they harvest both the things, income from rents and appreciation, capital gains from appreciation. Not just that, they also write off depreciation. They also get to write off all the expenses against this property, and that's how they keep getting the major share of the incomes from these properties. But today I'm just going to talk about tips for those that have one or two properties or more, and how should they file taxes. So while going for taxes, remember that in case of an investment property, you will be able to subtract. So your income is the rental income, anything that you charge for parking, anything that you charge for laundry, all that is income. And your expenses are your mortgage interest, not the principal out of the mortgage. So when you pay the mortgage, there are two parts to it. One is the principal, the second is the interest. The principal is what you write from one bank account, and it actually reduces your mortgage balance by the same amount for the next month. So you don't end up paying the interest. So principal is not tax deductible, but the interest is an expense. If your home or property is in a HOA and you are paying any sort of homeowners association dues, those are deductible too. So that's the departure from your primary home. So in case of an investment property, you take interest, you take property taxes and expenses as deduction, and then you subtract depreciation on the improvements. That's how you bring the net expense on your property. Now, in case of your primary home though, you only can take mortgage interest for deduction, and you can take property taxes. That too, that's capped up to $10,000. Now, in case of an investment property though, you can take the entire property tax as a write-off. Cool? Now that. But additionally, if you spend say $15,000 on a roof, now that's an expense you might think, but go talk to your tax consultant. That's not an expense that happened 1 year, like your utility bill that got consumed for 1 month. Or that's not an expense like you send somebody to fix, say, a garbage disposer. That's not that. So because this expense, the roof remains on the property for 15 years or 25 years, you have to write off that in that much period. And so then that goes under depreciation. So you have to first capitalize and then depreciate. But all this, go talk to your CPA, or if you're doing your taxes using some software, that is where you need to plug these things in and then choose the appropriate categories, and that's how you get your deductions. So the biggest difference is, in case of a primary home, you cannot subtract anything but mortgage interest, that too only on the first $750K, and property taxes only up to $10,000. But in case of an investment property, the entire mortgage interest, the entire property taxes, all the expenses, and then you take depreciation. Remember that depreciation is not a real expense. It's accounting and keeping cash aside for the possible loss of value in the property because of age. So you're not really paying somebody out by giving depreciation, but you're taking it down from your taxes as expense and keeping it to yourself. So it's in fact a cash flow while not paying taxes on it. That is what puts so much money into most people's pockets. Do you think this is helpful? Please like, subscribe, and click on the bell button. It will remind you next time I post a helpful video. And thank you. Thank you for watching. Bye.